You worked your whole life, saved your money, and now you're retired. But at 73 or 75, the IRS says you have to start pulling money out, whether you need it or not. And if you don't understand the rules, you could be looking at unnecessary taxes, or worse, penalties. It's not a suggestion, it's mandatory. Don't take it? Penalty is 25%. Used to be 50%, so it did come down. But if you forget to take $10,000, that's $2,500 in penalties right there. Still a big deal. Good news. Roth 401ks and Roth 403bs no longer have RMDs starting in 2024. Bad news. Traditional IRAs and 401ks still have RMD rules, and most of what you withdraw is taxable income. Today, we're breaking down what Secure 2.0 changed about RMDs, and how to plan so you don't get penalized and pay less tax. Here's what we're covering today. 1. What is RMD? Who has to take it? When does it start? 2. How is RMD calculated with a real example? 3. The 3 big Secure 2.0 changes. Higher starting age, Roth 401k or 403b exemption, lower penalty. 4. Decision framework, how to reduce the tax hit from RMDs. What is RMD? RMD stands for Required Minimum Distribution. Here's the simple version. You saved money in a retirement account and didn't pay tax on it at the time. It grew over the years, tax-free for now. Fast forward to 73 or 75. The IRS knocks on your door and says, time to pay your bill. You've got to take a minimum amount out every year. And that money is considered taxable income, for the most part. Unless you had after-tax contributions in there. That part's already been taxed, so you don't pay again. But for most people, the majority of what you take out is taxable. If you're still more than a decade away from 73, this video is for you to know the rules ahead of time. No action needed yet. Knowing early means you won't be caught off guard. Alright, so which accounts actually have RMDs? Here's the list. Traditional IRA. Yes. SEP IRA. Yes. Simple IRA. Yes. 401k. 403b. 457b. Also yes. If it's a pre-tax retirement account, chances are RMDs apply. Now, which ones don't? Roth IRA. Never had RMDs during your lifetime. That money can just sit there and keep growing. And starting in 2024, Roth 401ks and Roth 403bs are also off the hook. Secure 2.0 eliminated RMDs for them too. So what happens if you don't take it? Under Secure 2.0, the penalty is 25% of whatever you should have taken. That's down from 50%. So it's better, but still painful. If you catch it within 2 years, withdraw the money and amend your return. The penalty drops to 10%. When does RMD start? RMD starting ages have changed multiple times in recent years. Let me lay out the current rules clearly. Under Secure 2.0, the RMD starting age depends on your birth year. Those born in 1950 or earlier already started RMDs at the old age, 70 and a half or 72. Those rules still apply. This age change doesn't affect you. So, when is your first RMD actually due? Under IRS rules. Your first RMD is due by April 1st of the year after you turn 73 or 75. So if you turn 73 in 2026, your first RMD is due by the 1st of April 2027. Now here's the trap. That April 1st extension, it only applies to your very first RMD. If you take it, you still have to take your second RMD by December 31st of that same year. So you're looking at 2 RMDs in 1 calendar year, which could easily push you into a higher tax bracket. Most financial advisors recommend just taking your first RMD in the year you turn the RMD age. Don't wait until April 1st. Avoid that double tax trap. How to calculate RMD. The RMD formula is actually simple. RMD equals December 31 prior year balance divided by IRS Uniform Lifetime Table Factor. Most people use the IRS Uniform Lifetime Table. It doesn't consider your actual beneficiary. The only exception. If your spouse is your sole beneficiary and is more than 10 years younger than you, you can use the Joint Life Expectancy Table, which gives you a smaller RMD. Let's look at a real example. Meet Sarah. She turns 73 in 2026. At the end of 2025, her traditional IRA balance was $850,000. Now, to figure out her RMD for 2026, she takes that $850,000 and divides it by the IRS factor for her age, at 73. That's 26.5. So $850,000 divided by 26.5 gives her roughly $32,075. That's how much Sarah has to take out for 2026. She's got until December 31st to do it. Or if it's her first one, she could technically push it to April 1st of 2027. But as we talked about, that might not be the best idea. And here's the kicker. That $32,075 gets added to her taxable income for 2026. So she's not just taking money out, she's also adding to her tax bill. Next up, two important things. Roth 401k's got a major change. And if you have multiple retirement accounts, the rules are a little different. This is one of the most popular changes in Secure 2.0. Before 2024, Roth 401k's and Roth 403b's had RMDs just like traditional plans, even though you already paid tax on the contributions. Starting the 1st of January 2024, Secure 2.0H eliminated RMDs for Roth 401k's and Roth 403b's. What this means: if you contributed to a Roth 401k during your working years, you can now leave that money in the account to keep growing tax-free. You never have to take it out during your lifetime. This is especially valuable for high earners. Roth 401ks have no income limits, unlike Roth IRAs. And now they have no RMDs either. What about multiple accounts? For IRAs, you can add up RMDs from multiple traditional IRAs and take the total from any one IRA. You don't have to take from each separately. For 401ks, each 401k's plan has its own RMD. You can't add them up and take from one. 403b plans follow the same rule as 401k's. Each plan has its own RMD. Practical tip: if you have multiple 401k's from former employers, consider consolidating them into a traditional IRA for more flexibility. But remember, 401k's generally have stronger creditor protection than IRAs. Next, penalty dropped. But there are two traps you need to watch out for. Secure 2.0H lowered the RMD penalty from 50% to 25%. If you correct it within 2 years, withdraw the missed amount, and file an amended return, the penalty drops further to 10%. Let's put this in real numbers. Say Mike forgets to take a $10,000 RMD. The penalty on that? 25%, which is $2,500. Now, if he catches it within 2 years and fixes it, that penalty drops to 10%. So $1,000. But here's the thing. He still owes income tax on that $10,000. So the total hit is still significant. It's not just the penalty, it's the tax on top of it. Now, two critical traps. Trap 1. Delaying first RMD to April 1. This is the trap people miss most often. Your first RMD can be delayed to April, one of the year after you turn 73 or 75. Sounds flexible, right? But if you delay, you'll also have to take your second RMD by December 31 of that same year. 2 RMDs in 1 year. Result? 2 RMDs combined could push you into a higher tax bracket. So most financial advisors recommend taking your first RMD in the year you turn the RMD age. Don't wait until April 1. Trap 2. Still working? You might have an exception. If you're still working for an employer and you own no more than 5% of that company, you can delay RMDs from that specific employer's 401k until you actually retire. This rule does not apply to IRAs or 401ks from former employers. This exception is IRS allowed, but whether your plan actually offers it depends on your current employer's 401k plan provisions. Not all plans allow this. Check your plan documents. Now the most important part. RMDs are mandatory, but you can plan ahead to reduce the tax hit. Priority order for 3 strategies. I'm not just going to list strategies. I'll tell you which one to prioritize. If you have charitable giving plans, QCD is your top priority. If you're still years away from RMD, around 60, Roth conversions are your top priority. If you have neither charitable plans nor room for Roth conversions, at minimum, plan your account withdrawal order. Let's look at each. Strategy 1. Roth conversion. Best for people in their 60s. Roth accounts have no RMD, whether Roth IRA or Roth 401k. Before RMDs start, before 73 or 75. Convert some traditional IRA money to Roth IRA gradually over multiple years. You'll pay tax on the conversion, but you'll reduce future RMD size. Best window. Between retirement and 73 or 75, when you likely have no wage income and a lower tax rate. Let's put this in real numbers. Mike has $1 million in traditional IRA at age 70. He converts $100,000 to Roth each year for 5 years. $500,000 goes to Roth. Traditional IRA balance drops to $500,000. When RMDs start, his RMD drops from about $37,700 to about $18,800, saving thousands in taxes each year. Roth conversions create taxable income in the year of conversion. This could push you into a higher tax bracket or affect Medicare IRMA. Run the numbers with a tax advisor before committing. Strategy 2. Qualified Charitable Distribution, or QCD. If you're 70 and a half or older and you like to give to charity, this is a really good one. You can send money directly from your IRA, traditional IRA, SEP IRA, simple IRA, straight to a qualified charity, up to $109,000 a year in 2026. And that number goes up with inflation. Here's the beauty of it. That money doesn't count as taxable income for you, but it can still satisfy your RMD requirement. So you're doing good, and you're saving on taxes. Now, one catch. You can only do this from an IRA, not from a 401k. And here's another important detail. QCDs can offset your RMD for the year. But if you donate more than your RMD, the extra doesn't give you a tax deduction, and you can't roll it over to next year. So it's best used to cover your RMD, not to go over it. Strategy 3. Withdrawal order. And this one applies to pretty much everyone. Before you hit RMD age, you want to pull from your taxable accounts first. Your regular brokerage accounts, not your retirement accounts. Then go to your traditional retirement accounts, IRA, 401k. Or do Roth conversions if it makes sense. And leave your Roth accounts untouched for as long as you can. Why? Because Roth has no RMD and it grows tax-free. It's your most valuable bucket. Now here's the key. This order applies before RMD age. Once you actually reach RMD age, you have to take your RMD first. That's non-negotiable. After that, you can arrange additional withdrawals however you want. So the recommended order goes like this. First, taxable accounts. Your regular brokerage, savings, things like that. Second, traditional retirement accounts. IRA, 401k. And last, Roth accounts. Tax-free, no RMD. Your ace in the hole. All right, Let's wrap it up. RMDs in a nutshell. First, know your number. Born in 1959 or earlier, your RMD age is 73. Born in 1960 or later, it's 75. That's the biggest change from Secure 2.0. Second, if you have a Roth 401k or Roth 403b, good news. No more RMDs, starting in 2024. This one's been super popular. Third, the penalty came down from 50% to 25%. Better, but still painful. Forget to take $10,000? That's $2,500 gone. So don't ignore it. And fourth, plan ahead. If you do Roth conversions before your RMD age, you can seriously reduce your tax bill down the road. Know your age. Know the rules. Plan early. That's it. I'm Gino. Next episode, we're covering 2026 retirement account limit updates. How much more can you contribute this year? 401k went up, IRA went up, and there's a new rule for high earners on catch-up contributions. See you then.